Most people spend decades carefully saving for retirement, watching their 401k and IRA balances grow, only to discover something painful once they actually stop working. Taxes can take a much bigger bite out of their money than they ever expected. You can do everything right: max out your accounts, invest in low-cost index funds, avoid debt, and still watch a surprising portion of your hard-earned savings disappear in taxes during retirement. The good news is that a large part of this tax burden is not inevitable. With the right understanding and a few deliberate decisions, many retirees can significantly reduce what they pay. This video is the complete, plain English guide to how taxes actually work in retirement and the practical ways to keep more of your money. Let's start with the most important idea. In retirement, the government does not tax your money. It taxes the type of account the money comes from and the order in which you take it out. That single distinction changes everything. There are essentially three buckets of money most people have. The first bucket is tax-deferred accounts. These include traditional 401(k)s, traditional IRAs, and similar plans. You got a tax deduction when you put the money in. The money grew without being taxed each year. But when you take it out in retirement, every single dollar is taxed as ordinary income, the same way your paycheck was taxed while you were working. There is no special lower rate. It is fully taxable. The second bucket is tax-free accounts. The main one is the Roth IRA and Roth 401k. You already paid tax on the money before it went in. As long as you follow the rules, every dollar that comes out in retirement, including decades of growth, is completely tax-free. No federal income tax. In most cases, no state income tax either. The third bucket is taxable accounts. These are regular brokerage accounts. You buy and sell stocks, funds, or other investments with money that has already been taxed. You pay tax only on the growth. Capital gains and dividends and long-term capital gains are usually taxed at lower rates than ordinary income. You also have complete flexibility. You can take the money out whenever you want without the early withdrawal penalties that apply to retirement accounts. Understanding these three buckets is the foundation of paying less tax in retirement. Most of the strategies we will discuss are simply about deciding which bucket to take money from, when, and how much. Now let's talk about the tax brackets themselves, because this is where many people get surprised. While you are working, your income is relatively steady. In retirement, your income can jump around a lot depending on how much you withdraw, when you claim Social Security, and when required minimum distributions begin. The federal income tax brackets still apply, but the way your income is calculated changes. Social Security benefits can become taxable. Capital gains can push you into higher brackets. And once you reach a certain age, the government forces you to start taking money out of traditional retirement accounts whether you need it or not. That forced withdrawal is called a required minimum distribution, or RMD. Starting at age 73 for most people, the age has been rising with recent legislation. You must withdraw a certain percentage of your traditional IRA and 401k balances every year. The percentage increases as you get older. If you do not take the required amount, the penalty is severe. The problem is that these forced withdrawals are fully taxable. For someone who has saved diligently in a traditional 401k, RMDs can push them into a higher tax bracket precisely when they wanted their tax rate to be lower. This is one of the main reasons that "I'll just wait and pay taxes later" strategy can backfire. Many people assume they will be in a lower tax bracket in retirement. Sometimes that is true. Often it is not, especially once RMDs and Social Security are both in the picture. Social Security taxation is another area that confuses almost everyone. A portion of your Social Security benefits can become taxable depending on your other income. The calculation uses something called combined income, your adjusted gross income plus non-taxable interest plus half of your Social Security benefits. If that number crosses certain thresholds, up to 85% of your Social Security benefits can be taxed. Notice what this means: the more you withdraw from your traditional IRA or 401k, the more likely you are to make your Social Security taxable. One decision affects the other. So how do you actually pay less? The single most powerful concept is called tax-efficient withdrawal order, or tax bracket management. Instead of randomly taking money from whichever account is convenient, you deliberately choose the source of your withdrawals to keep yourself in the lowest possible tax brackets over time. A simplified version of a smart order looks like this. In the early years of retirement, before RMDs begin, many people benefit from taking money first from taxable brokerage accounts, especially positions with long-term capital gains, and from Roth accounts if needed. This keeps taxable income lower. During these years, some retirees also do Roth conversions, deliberately moving money from a traditional IRA to a Roth IRA and paying tax now at a controlled rate so that future RMDs will be smaller. Once RMDs begin, the strategy often shifts. You take the required amount from traditional accounts, then fill in additional spending needs from taxable or Roth accounts depending on your remaining tax room. The goal is not to avoid tax forever. The goal is to smooth your tax rate across many years instead of having very low tax years followed by very high tax years when RMDs hit. Roth conversions deserve special attention because they are one of the most flexible tools available. A Roth conversion means you take money from a traditional IRA or 401k, pay ordinary income tax on that amount in the current year, and move it into a Roth IRA. From that point forward, the money grows tax-free and can be withdrawn tax-free. Why would anyone voluntarily pay tax early? Because they believe their tax rate today is lower than it will be later, or because they want to reduce future RMDs, or because they want to leave tax-free money to heirs. Conversions work especially well in years when your income is temporarily lower, for example, after you stop working but before Social Security and RMDs begin. These gap years are often the best window for conversions. There are limits and rules. Conversions increase your taxable income in the year you do them, which can affect other things such as Medicare premiums, IRMAA, and the taxation of Social Security. You also need cash from outside the retirement account to pay the tax, otherwise you reduce the amount that ends up in the Roth. Still, for many people with large traditional balances, a series of careful conversions over several years can save substantial tax later. Another powerful and underused strategy is the qualified charitable distribution, or QCD. If you are 70 and a half or older and you give money to charity, you can transfer funds directly from your IRA to a qualified charity. That amount counts toward your RMD but does not appear in your taxable income. It is one of the cleanest ways to satisfy a required distribution while reducing taxes, provided you are going to give to charity anyway. Capital gains management also matters. In taxable accounts, long-term capital gains have their own preferential rates. In some years you may even be able to realize gains at a 0% federal rate if your taxable income stays below certain levels. This creates opportunities to rebalance or harvest gains in low-income years. State taxes are another lever. Some states do not tax retirement income at all, or they exclude a large portion of pension, Social Security, or IRA withdrawals. Moving from a high-tax state to a low-tax or no-income tax state can produce meaningful savings, though it is a life decision, not just a tax decision. You also need to understand how long you must live in the new state for the change to be respected. Medicare premiums introduce yet another complication. Higher income and retirement can trigger IRMAA income-related monthly adjustment amounts, which means you pay significantly more for Medicare Part B and Part D. The look-back is usually 2 years, so income in the year you are 63 can affect premiums when you are 65. Roth conversions, large capital gains, and big traditional IRA withdrawals can all push you over IRMAA thresholds. Planning around these cliffs is part of sophisticated tax management in retirement. Let's bring this down to practical steps most people can actually take. First, get clear on what you currently have in each of the 3 buckets: traditional, Roth, and taxable. Write down the balances. This is the starting map. Second, estimate your spending need in retirement and compare it to guaranteed income sources such as Social Security and any pensions. The gap is what must come from your portfolio. Third, look at the years between retirement and the start of RMDs. These years are often the most valuable for Roth conversions and for drawing down taxable accounts. Fourth, once RMDs begin, calculate the required amount each year and decide whether you need more than that. If you need more, choose the most tax-efficient source for the extra amount. Fifth, consider whether charitable giving can be done through QCDs once you are eligible. Sixth, watch the IRMAA thresholds and the Social Security taxation thresholds so you do not accidentally create unnecessary extra taxes or surcharges. None of this requires exotic investments or aggressive risk. It is mostly about sequence, timing, and account location. It is also worth saying what this is not. Paying less tax in retirement is not about finding a secret loophole that eliminates all taxes. It is about understanding the rules the tax system already has and arranging your withdrawals so that you stay in lower brackets for more years and avoid stacking income in ways that create extra taxation of Social Security or higher Medicare premiums. Many people feel overwhelmed when they first see all of these moving pieces. That is normal. The system is complicated by design. But you do not need to master every detail at once. The biggest gains usually come from three decisions: 1. Getting the withdrawal order roughly right, 2. Using the years before RMDs wisely, and 3. Avoiding large, unplanned spikes in taxable income. If you have a large traditional retirement balance, the single highest leverage question to ask is, what will my RMDs look like at 75 or 80 if I do nothing? Running that simple projection often motivates people to start conversions or adjust their savings location while they still have time. For those earlier in their careers, the lesson is equally clear. The account type you choose today determines how flexible and tax-efficient your retirement will be decades later. Putting everything into traditional accounts maximizes the tax deduction now but concentrates tax risk later. Building at least some Roth and taxable savings creates options. Taxes in retirement are not a single problem with a single solution. They are a series of connected decisions that unfold over many years. The retirees who pay the least tax relative to their wealth are usually not the ones who found a clever trick. They are the ones who understood the three buckets, managed their tax brackets deliberately, and treated the years before RMDs as a planning window rather than a time to coast. This video is the foundation. In the rest of this series we will go deeper into each major strategy, how to execute Roth conversions without creating new problems, the precise order of withdrawals that works for different situations, how Social Security taxation really works with examples, what to do about RMDs, how QCDs function, whether moving to a different state makes sense, and how to avoid IRMAA surprises. Each topic builds on the map we have just laid out. If you take only one thing from this overview, let it be this: the tax you pay in retirement is not fixed. It is largely determined by the decisions you make about which accounts to draw from and when. Those decisions are still under your control.